My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject Financial Risk Management as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Exam tip. Focus especially on product versus capital market risk, risk process and reporting. These are repeatedly asked in Osmania University papers. Unit 1 first important short question is Product market risk. Product market risk means the risk a company faces when its products or services do not perform well in the market. This can happen due to changing customer preferences, new competitors, price wars, or technology changes. Example. Suppose a company sells traditional watches. But now, people prefer smartwatches. If the company doesn't adapt, its sales will fall. This loss is called product market risk. Main causes. Launching products without market research. Ignoring customer trends. Strong competition. Poor pricing or outdated products. How to control it? Understand customer needs. Monitor market trends. Innovate and upgrade products. Create strong branding and promotions. If you don't study the market will study your failure. Managing product market risk helps a company stay in business and grow successfully. Next important short question is 2 capital market risk elements. Capital market risk refers to the risk of losing money due to changes in the stock market, interest rates, or economy. It mainly affects investors, banks, and companies that buy or sell financial assets like shares, bonds, or mutual funds. Example. If an investor buys shares at 1000 rupees each and the market crashes, the price may fall to 600 rupees. The 400 rupee loss is due to capital market risk. Key elements of capital market risk. 1. Equity risk, loss due to falling share prices. 2. Interest rate risk, changes in interest rates affect bond values. 3. Foreign exchange risk, loss from currency rate changes. 4. Liquidity risk, when it's hard to sell investments quickly. Why it's important? Understanding these risks helps companies and investors make safer financial decisions and avoid heavy losses. Smart investors don't fear risk, they manage it. Next important short question is 3. Risk indicators. Risk indicators are like early warning signs that help companies identify possible risks before they become big problems. These indicators show that something may go wrong in the future and action is needed. Example. If a company's sales are falling every month and customer complaints are increasing, these are risk indicators. They warn that the company may soon face financial or market problems. Common risk indicators. 1. Drop in revenue or profit. 2. High employee turnover. 3. Increase in customer complaints. 4. Delays in project deadlines. 5. Negative media or public feedback. Why risk indicators are important? Help in early detection of problems. Allow management to take quick action. Save the company from losses and failures. A good company doesn't wait for trouble, it watches for signs. Next important short question is 4. What is liquidity risk? Liquidity risk means the risk that a company or person doesn't have enough cash to pay its bills or meet urgent expenses. It happens when assets can't be quickly converted into cash without losing value. Example. A company owns a big building worth 1 crore rupees, but it needs 5 lakhs rupees urgently to pay salaries. If the company can't sell the building quickly or take a loan, it faces liquidity risk. Types of liquidity risk. 1. Funding liquidity risk, not having enough cash to pay short-term debts. 2. Market liquidity risk, not being able to sell assets quickly in the market. Why it's important? It can cause delays in payments, may damage business reputation, can even lead to bankruptcy. Assets are good, but cash is king in emergencies. Next important short question is 5. Scope of risk. Scope of risk means the different areas in which a business or person can face uncertainty or loss. Risk is not only about money. It can affect operations, employees, customers, markets, and reputation. Example: a mobile company launching a new phone may face financial risk, cost may go high. Market risk, customers may not like it. Operational risk, production may delay. Legal risk, some patent issue. All these areas show the scope of risk. Main areas covered in scope of risk. 1. Financial risk, losses in investments or funds. 2. Operational risk, problems in daily work. 3. Strategic risk, wrong business decisions. 4. Compliance risk, not following legal rules. 5. Reputation risk, damage to public image. Wherever there's a goal, there's a risk. Understanding the scope helps us plan better. Next unit 1. Long questions. First important long question is 1. Discuss the nature, need and scope of risk management. Nature of risk management. Risk management is the process of identifying, assessing, and controlling risks that may affect a business. Risk is a part of every business decision. It may come from financial losses, market changes, legal issues, or natural disasters. Risk management helps businesses to predict future problems and take steps to avoid or reduce them. It is a planned and continuous process that protects a company from losses. Example: a bank checks your credit history before giving a loan. This is risk management to avoid default. Need for risk management. 1. To avoid financial losses by detecting risks early. 2. To make better decisions based on risk reports. 3. To ensure business stability even during crisis. 4. To protect assets and people like employees and infrastructure. 5. To comply with legal rules and avoid penalties. Scope of risk management. Risk management covers many areas of business, such as financial risk, loss due to currency change, interest rates, etc. Market risk, loss due to price changes or competition. Operational risk, machine failure, system errors, human mistakes. Strategic risk, poor decisions, lack of innovation. Legal and compliance risk, breaking rules and facing fines. Reputational risk, negative image in public or media. Example: if a food company doesn't follow hygiene laws and gets bad media coverage, it faces legal and reputational risk. Conclusion: risk is unavoidable, but it can be managed smartly. A strong risk management plan helps businesses to grow with confidence, face challenges, and stay ahead of competitors. Don't fear risk, prepare for it. Next important long question is: to explain the types of risk, product market risk, and capital market risk. 1. Product market risk. Product market risk refers to the risk of losing sales or profits due to changes in customer needs, competition, pricing, or market trends. It directly affects the demand for a company's products or services. Causes of product market risk. new competitors with better products. Change in customer preferences. Incorrect pricing. Poor product quality or outdated design. Weak marketing or branding. Example. Imagine a company sells feature phones, but people now prefer smartphones. If the company doesn't adapt, it will lose customers and profits. This is product market risk. How to manage? Regular market research. Product innovation. Competitive pricing strategies. Strong marketing campaigns. 2. Capital market risk. Capital market risk is the risk of loss from investments in financial markets like stocks, bonds, or mutual funds. It mostly affects investors, banks, and companies dealing with large-scale investments. Causes of capital market risk. Fall in stock prices. Interest rate changes. Political or global instability. Currency fluctuations. Poor financial performance of companies. Example. An investor buys 100 shares at 100 rupees each. Due to a stock market crash, the price falls to 60 rupees. The investor loses 4,000 rupees. This is a capital market risk. How to manage? Diversify investments. Monitor market trends. Invest for the long term. Use risk analysis tools. Conclusion. Both product market risk and capital market risk are very important in financial risk management. One affects sales and customers, the other affects investments and returns. In business, it's not about avoiding risk, it's about managing it smartly. Next important long question is 3. Discuss the risk management process. The risk management process is a step-by-step method that helps businesses to identify, understand, and control risks. It ensures that unexpected problems do not stop business growth or cause heavy losses. Step 1. Risk identification. In this step, the company finds out what types of risks it may face: financial, market, legal, or operational. Example, a bank checks for risks like loan defaults or cyber attacks. Step 2. Risk analysis assessment. Here, the business checks how serious the risk is. It looks at the impact, loss, and the likelihood, chance of that risk happening. Example, if a supplier delays raw materials, production may stop. This risk is high if the supplier is unreliable. Step 3. Risk evaluation. In this stage, the risk is compared to the company's risk tolerance, how much risk it can handle. The business decides which risks need quick action. Step 4. Risk treatment, control. Now, the company decides how to handle the risk. Avoid the risk, don't take it. Reduce the risk, use safety measures. Transfer the risk, buy insurance. Accept the risk if it's small. Example, a company buys fire insurance to transfer fire risk. Step 5. Monitoring and review. Risks can change with time. So, companies must regularly check and update their risk plans and actions. Step 6. Communication and reporting. The team must share risk updates with all departments and top management so that everyone is aware and prepared. Conclusion. The risk management process helps a business to take smart decisions, reduce losses, and grow safely. Risk is like fire. If controlled, it cooks your food. If ignored, it burns your house. Next important long question is 4. Explain risk reporting process, internal and external. Risk reporting process, internal and external. The risk reporting process is the way a company shares information about risks with the right people at the right time. It helps in better decision-making and ensures that everyone is aware of possible dangers. Risk reporting can be of two types: internal reporting, external reporting. Internal risk reporting. This means reporting risks within the organization to managers, department heads, and top executives. It helps in daily operations and planning. Purpose: to inform key employees about possible risks, to take quick action, to make strategic decisions. Example: a factory manager reports that a machine is overheating. This internal report helps in preventing a major breakdown. What it includes: daily risk dashboards, monthly risk reports, risk alerts to relevant departments, reports on operational, financial, and safety risks. External risk reporting. This is when companies report risks to outside parties like investors, regulators, government agencies, or the public. It builds transparency and trust. Purpose: to follow legal rules, compliance, to maintain investor confidence, to show corporate responsibility. Example: a bank must report credit risk levels to the Reserve Bank of India, RBI, every quarter. What it includes: annual risk disclosures in financial statements, reports to stock exchanges, environmental and safety risk reports, cybersecurity risk updates to authorities. Conclusion: both internal and external risk reporting are important. Internal reports help in quick decision-making, while external reports help in legal compliance and public trust. When risks are reported clearly, solutions are found early. Next important long question is: 5. Explain a comprehensive view of risk in financial institutions. A comprehensive view of risk in financial institutions. Financial institutions like banks, insurance companies, and mutual funds deal with a lot of money every day. Because of this, they face many types of risks. A comprehensive view means looking at all risks together, not just one at a time. Why is it important? If a bank only focuses on loan risk but ignores technology risk or fraud risk, it may suffer big losses. So, financial institutions need a full 360-degree view of all possible risks. Types of risks in financial institutions. 1. Credit risk, when borrowers don't repay loans. Example: a customer takes a home loan but fails to pay EMI. 2. Market risk, due to changes in share prices, interest rates, or currency rates. Example: a fall in stock prices affects mutual fund returns. 3. Liquidity risk, not having enough cash when needed. Example: a bank cannot give cash to depositors during high withdrawals. 4. Operational risk, due to system failure, fraud, or human error. Example: a technical error causes wrong transactions. 5. Legal and compliance risk, breaking financial laws or rules. Example: not following RBI guidelines may result in a fine. 6. Reputational risk, loss of public trust. Example: news of fraud in a bank can reduce customer confidence. How to manage all risks together? Use risk management software. Set up a risk committee. Regular audits and compliance checks. Staff training and awareness. Develop a risk culture where every employee helps detect and prevent risk. Conclusion: a comprehensive view of risk means watching all areas together. This helps financial institutions to stay strong, protect public money, and grow safely. A bank that sees all risks clearly can handle any storm wisely.